the risk primarily is, if you do this and you buy Bitcoin and Bitcoin doesn't go up forever, then what happens? Well, the equity investors aren't going to make a lot of money on that trade, right? If you're paying SOFR plus a credit spread or 10% and Bitcoin goes up 0%, the equity investors in the company didn't make money on that trade. But that's all. You don't really want to stop. If someone were to give you $10 billion and you didn't buy Bitcoin, then you actually lose the 30% ARR that's paying the dividend. So now you have to find something else to invest in that's going to perform 30%. And so what is that something? And the answer is, here's the answer. I don't think there's anything better, right? I think that that's the best long-term capital investment. But it doesn't really matter whether you agree with me or not. The point is, for example, you're walking across the street, looking the wrong way, worrying about the quantum threat. But the thing that really could go wrong is you get hit by a truck. And so the real threat is you get hit by a truck because you're not looking both ways while you cross the street, and you're worried about something that is a hypothetical threat some number of years out that may or may not happen, that may or may not be solved before you have to do anything about it. It turns out that, I think people are very focused upon quantum because they ran out of all the other things to worry about. We used to have the energy problem. We used to have the China problem. The miners weren't going to mine. The miners are going to mine too much. The energy is going to be too expensive. There won't be enough energy. We'll be shut down. The government will ban this. The government won't ban this. Wall Street won't want it. People won't buy it. I could list 100, right? Satoshi worry. People ask Satoshi back in the day about the quantum threat.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
When I borrow against an underlying asset with the obligation to meet a collateral call on 1 or 2 days' notice. So margin debt is 1 day money. And if you actually borrowed against the underlying Bitcoin, if you're a retail investor, you're basically borrowing the money for a day. And when you have volatility, that creates a lot of anxiety. When we sell STRC, we're selling equity. It's the exact opposite. If you give me $1 million for my equity, for common equity, I have the money forever with no obligations. Okay, that's the longest duration money. When you give me $1 million to buy a preferred equity with a variable dividend, if you read the securities document and you understand what that security is, you're entering into a perpetual swap. I am agreeing as the issuer to give you SOFR, the standard overnight funds rate, plus a credit spread determined by the company. And you are agreeing to give the company that capital forever. And so and you're not getting the money back. So it's not an overnight loan. There is no collateral call. You have no redemption right. You can't, it's not like you can go to the bank and say, give me the $1 million back tomorrow. In fact, you're not getting the money back ever, right? It's an equity investment. If you wish to sell the instrument, you can sell it into the market, but you're selling it to other investors. And so the magic of this structure is you're creating a perpetual swap that's got stochastically, if you were to actually do the statistical modeling, it's more like a 20-year duration instrument. So you like the issuer has the money for about 20 years, right? Not if you were to borrow money from a crypto exchange, you have the money for 20 minutes, right? And if you were to borrow the money in a conventional margin loan, you have the money for 20 hours to 2 or 3 days. But so, I mean, Bitcoin could fall 95%. It doesn't create there is no liquidation. It's not a credit instrument or a debt instrument in that way. It doesn't come due in 5 years. It doesn't come due ever, right? And so this is the ideal kind of credit instrument for a volatile environment, because the way it works for the company is the company is paying a dividend to stabilize it But in the event that the credit of the company improves, if there's too much demand, the company can reduce the dividend rate in order to decrease the demand. And if SOFR falls to 50 basis points, the company's obligation is to pay you 50 basis points. I mean, and what happens if the company can't pay that? Well, by law, you can't pay a dividend on a preferred stock that would create an insolvency event for the issuer. Like, the board has to approve the dividend. So you understand, like, it's literally impossible. It is literally impossible to create an insolvency or to bankrupt an issuer of a preferred stock, right? So people worry that, but whereas if you basically borrowed $1 million from an exchange, they wipe you out in 1 minute. You're gone. But in this particular case, in 27 years, after a parade of 947 horribles, right? If the company couldn't pay the dividend without being insolvent, it would suspend the dividend for 12 weeks. You know, it's like, okay, so what is the risk? It's an equity risk. It's not a credit risk in the sense of there's no credit instrument that comes due that unwinds the capital structure. The risk primarily is, you know, if you do this and you buy Bitcoin and Bitcoin doesn't go up forever, then what happens? Well, the equity investors aren't going to make a lot of money on that trade, right? If you're paying SOFR plus a credit spread or 10% and Bitcoin goes up 0%, the equity investors in the company didn't make money on that trade. But that's all. It just wasn't profitable to the equity. And if you're wrong for 50 years, well, then there might be a risk to the preferred equity. But you see, we've taken something that would be a risk in the next 50 minutes or 50 hours or 50 days, and we've turned it into a 50-year risk for the credit investor. It's like we literally have 50 years of dividends, right? Like, how do you create this? Well, you're over-collateralized by a factor of 10, 20, 30. So a lot of times people think, they don't really understand the math that well. If Bitcoin goes up 2%, we've got a $50 billion equity tower. That means we're making $1 billion a year. That's the dividends. So the break-even point for us is 2%. So if you don't think Bitcoin's going up 2%, you probably shouldn't be an equity investor in a Bitcoin company, right? Right? Like, so there's no equity investor that thinks Bitcoin isn't going up 2%, right? But if it goes up 2%, we can pay the dividends forever and create shareholder value. If it goes up 10% a year, well, 10 or 11, maybe a little bit less because the math is kind of complicated. We get the benefit of the float. But if you expect Bitcoin to go up 10% over the next decade, it's a screaming home run for the equity investors. If you think Bitcoin's going up 0% a year for 100 years, well, in like 55 years, we have to do something. But I mean, like, we do things faster, right? Like, you think I'm going to sit around for 55 years and not do something? Look at all the things we've done in the past 5 years, right? So at the end of the day, if you wanted to acquire Bitcoin with leverage, okay, the least risky way to do it is you sell common equity at a premium to the underlying NAV of the company. That is, so if the equity is trading at 2 times NAV, you sell $1 billion of equity, you buy $1 billion of Bitcoin backed by 500 million of NAV, you just captured a $500 million gain up front, and it is risk-free forever, okay? That is the lowest risk way. And we did a lot of that, right? That's why people are wondering, why did you actually sell equity when you're trading at 3 times NAV and we sold $21 billion of it? It's like, why do you do that? Because we made $14 billion risk-free in a matter of weeks. Why wouldn't you do that? What's the second best way, right? Let's say you can't do that, right? I mean, that trade isn't always there, and eventually it dries up. And right now with Bitcoin treasury companies, there aren't any Bitcoin treasury companies trading at 2 or 3 times NAV. So the second best way is you buy Bitcoin with a variable rate perpetual preferred stock. You enter into what is in essence a nearly risk-free swap. You're going to give me $1 billion. I'm going to buy $1 billion of Bitcoin. I'm going to agree to pay you a monthly dividend, currently 11%. I'm never giving you back the billion. Now, over the course of 20 years, what is the average dividend rate on Stretch going to be? Well, probably 8, right? It's probably, 11.5% is kind of the rate right now while Bitcoin is in a bear market and the volatility is 55 and everyone is concerned and this is a new thing. But don't you think after 3 to 5 years after this instrument's been in the market, the vol of Bitcoin comes off, Bitcoin appreciates? Probably, even if SOFR's 370, we won't have an 800 basis point credit spread against SOFR. We'll probably have a 400, 500, 300 basis point credit spread. So if you look out over time, it's like, would you agree to pay 8% or 9% in order to buy an asset which is going up, you think 29%? Sure. Well, and what if we're wrong? Well, what if it goes up 10%? Okay, we'll just make a little bit of money. What if it goes up 0%? Well, anything is possible except for the fact that I just told you there's only $30 million of Bitcoin available for sale every day, and we're buying all of it. Like we're buying. So it's not clear to me that it's going up 0% a year. What's the best way to predict the future? It's to determine the future, right? If we basically buy $100 billion of Bitcoin, it's probably not going up 0% a year for the next decade. I'm describing the business model, which is we issue credit, we acquire capital. If we stop issuing credit, we'll stop acquiring capital. But there's $300 trillion in the credit market, which is currently yielding SOFR plus a spread. And the spread is like 80 basis points to 200 basis points. So consider, what if we just wanted to convert 5% of that, right? You're getting to $15 trillion of credit. And can you pay better than 280 basis point credit spread? Sure, you can. So if you issue the credit, in order to actually make good on the credit, remember I said, where's the dividend coming from? It's coming from the capital appreciation. Where the real brilliance of the business model is you're acquiring a capital asset that you're holding in perpetuity and you're never realizing the capital gain on it. If you pay the dividend by remitting the unrealized capital gain back to the credit investor, the dividend becomes a return of capital dividend, which means it is also tax deferred. So the basic principle is I'm entering into a capital investment that I expect to hold in perpetuity, and I'm paying a dividend on the unrealized capital gains through issuing a derivative instrument that allows the credit investor to collect dividends for a decade, tax deferred. And should they die and pass that credit instrument to their heir, they get a step up in the basis. So you could be a retiree, collect dividends for 10 years, not pay tax, pass it through to your heir. They get a step up and they get 10 years of dividends that are also tax deferred. So the thing that makes the entire structure work is that you're making a capital investment for a credit investor, and you're absorbing the uncertainty of the future and the volatility of the present on the balance sheet of the common equity in order to strip the risk and strip the volatility from the credit investor's portfolio. And the credit investor is paying you handsomely for that, right? And everybody's getting what they want, right? The capital investors in Bitcoin get a benefit. The equity investors in strategy get amplification of Bitcoin, and the credit investor gets that stripped down, low volatility digital, instrument, digital yield instrument. And so you don't really want to stop. If someone were to give you $10 billion and you didn't buy Bitcoin, then you actually lose the 30% ARR that's paying the dividend. So now now you have to find something else to invest in that's going to perform 30%. And so what is that something? And the answer is, here's the answer. I don't think there's anything better, right? I think that that's the best long-term capital investment. But it doesn't really matter whether you agree with me or not. The point is, I run a public company, and all of the equity investors in the public company are Bitcoin maximalists, right? And so the people that hold MSTR believe that Bitcoin is going up more than 10 or 11%, and they want to outperform it. So when we're selling the credit to buy the Bitcoin, we are aligning with the equity investors. We're giving them what they want, which is more Bitcoin per share. We're supporting the Bitcoin ecosystem by buying the Bitcoin, providing liquidity, and then we're backing the credit with over-collateralized Bitcoin, like 5x as much Bitcoin as the credit. And if you're the credit investor, you're able to assess the credit risk by plugging in the price of Bitcoin, the volatility of Bitcoin, your opinion of the future ARR of Bitcoin. That spits out a credit risk for you. And if you go to our website, you'll see we've actually published that credit model. It's a very transparent credit model based upon the BTC rating of the credit instruments. BTC rating is the degree of over-collateralization. So $1 of credit backed by $5 of Bitcoin is a BTC rating of 5. So it's a long-winded answer to your question, but the point is the credit model is predicated upon a homogeneous collateral base. The equity model is predicated upon a homogeneous capital base, right? And that allows all of these investors to invest. Now, you might think, well, you're 100% all in on BTC. Well, yes, we are, but let me make one more point. The equity portfolio of the professional investor isn't. So if you're an equity investor, you might decide that you want 1% of your money invested in Bitcoin equity. Or you might decide you want 1% of your money invested in Bitcoin credit. So we are a pure play, transparent, understandable set of securities. And that way the investor can make intelligent decisions, whether it's to allocate, to hedge, to short, to go long, because we've given them this pure Bitcoin credit and this pure Bitcoin equity. If we were to diversify, if we were to hedge, we would be creating an opaque security, an obscure credit risk. And now it becomes very difficult to assess the risk. And so the issue is, it doesn't matter to me that the equity investor loves or hates Bitcoin. What matters is that they need to know that they can short $100 million of our security or go long $100 million and know that we're not going to obscure the credit risk or the equity risk, you see. So for us, we have created a pure play digital credit company. And to the extent that you don't believe, if you think Bitcoin's radioactive going to zero tomorrow, you don't want to touch any of this. But to the extent that you believe that Bitcoin is a real asset and you have an opinion on it, whether it's negative or positive, doesn't matter. If you have an opinion on it, you can rationally invest in it. You can trade it, you can arb it, you can short it, you can go long. And so that's why we're always 100% focused on Bitcoin as the backing capital structure for the equity and for the credit. And we don't need, look, if this was New York City, you're like, well, what happens when you bought up all of New York City? You know, what do you do next? Well, it might be a more complicated thing, but Bitcoin is global digital capital. It's not a little city. I'm not going to run out of Monet paintings to buy, right? It's the most pure manifestation of a capital asset. It's just pure economic wealth, right? Capital. So there's no reason to diversify. The more Bitcoin we buy, the better it is for the entire ecosystem, the less risky it is. And the less uncertain it is for all of the various investors, whether they're capital investors, equity investors, or credit investors that are involved with our company. Well, let me start with some basic philosophy. There are three types of people in this world. There are the optimist, there are the pessimist, and there are the alarmist. Okay, so optimists are people that think the future is uncertain. Lots of things are going to happen. And when those things happen, we'll figure out how to create the greatest degree of prosperity with it. If it's a threat, we'll deal with it at the time. If it's an opportunity, we'll find a way to harness it. Most new developments will be both an opportunity and a threat. Quantum computers. What happens if computers get better? Well, I happen to think that what happens if computers get better is that smart people find a way to make money off of computers getting better. And if you're in the digital capital business and computers get better, we'll probably figure it out. The optimists always look at the world in a constructive, cheerful way. I happen to be an optimist. I believe in the Bitcoin community. I believe in the crypto community. I think there are a lot of smart people. They're thinking about all of the things they're going to develop in the world. They'll come up with the best way to solve a problem if it's a problem. But there are other people who are going to think about a way to harness it to make money or create more utility, and that's good too. The pessimists always enumerate all the negatives, all the parade of horribles. I can give you a list of 100 things that could go wrong, 1,000 things that can go wrong. You know, we could talk about that for hours and hours and hours. I'm okay with pessimists. We need pessimists because if we don't think about all the things that might go wrong, then we won't be ready. But on the other hand, if I give you a list of 100 things that could go wrong, it's very important that you have a stochastic view of the world. Like you have to master probability and statistics. And you have to ask for example, you're walking across the street, looking the wrong way, worrying about the quantum threat. But the thing that really could go wrong is you get hit by a truck. And so the real threat is you get hit by a truck because you're not looking both ways while you cross the street and you're worried about something that is a hypothetical threat some number of years out that may or may not happen, that may or may not be solved before you have to do anything about it. It turns out that, I think people are very focused upon quantum because they ran out of all the other things to worry about. We used to have the energy problem. We used to have the China problem. The miners weren't going to mine. The miners are going to mine too much. The energy is going to be too expensive. There won't be enough energy. We'll be shut down. The government will ban this. The government won't ban this. Wall Street won't want it. People won't buy it. I could list 100, right? Satoshi worry. People ask Satoshi back in the day about the quantum threat. And what Satoshi said, he said, we can upgrade. Okay, so my short answer on the threat is we can upgrade. My more thoughtful answer is the optimists are comfortable. The pessimists are writing these papers. The alarmists are just seeking to aggrandize power and influence and money by amping this way out of proportion. I'm not an alarmist. I don't think people should be alarmist. I would caution anyone from making decisions based on alarmism because there's a tendency in this world for people to consider a hypothetical risk that's somewhere in the future, amp it up by a factor of 10,000 and then ask you for money. And normal, that's how I raise money. Like if I'm trying to finance my quantum startup, I'm like, quantum's a big threat. Why don't you give me a lot of money? In politics, it happens. It's like, well, if such and such gets elected, they're going to, shut down this business. Why don't you give me a lot of money? So you see this in politics. You see it in venture capital. You see it in medicine. It's like, well, like your 3-year-old might hypothetically get this disease when they're age 57. So why don't we just go ahead and vaccinate them out of abundance of caution right now? I think that the thing to always keep in mind, you guys remember The Hitchhiker's Guide to the Galaxy?
Oh, yeah.
What's on the back of the book?
Don't panic.
Don't panic. I think that, by the way, that was Douglas Adams, and that was, 40 years ago? Very good words. It's okay to consider all these things. It's okay to even study them and think them through. I think that the real mistake, the fatal mistake to avoid is panicking. And panicking means rushing into a cure for a hypothetical disease before you really understand the nature of the threat and the proximity of the threat. Because, and Nicholas Taleb makes this point a lot, it's like the side effects on a vaccine, it's like, oh, the vaccine, it creates awful side effects to 1% of the people that take it. The likelihood you'll get the disease is 0.01%. It's like if you rush into every cure and every treatment, you over-vaccinate. And Robert F. Kennedy made this point very articulately not so long ago. I think that with insurance, it's the same thing. It's like, I want to sell you insurance against slip and fall on a sidewalk. It'll cost you 1% of all your wealth. It's only 0.01% likely to happen, but if I can sell you 100 micro insurance policies, then I take 100% of your money and I insure you against 1% of the risk. And so the real issue here is, how should one react to a hypothetical threat?
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.